Good afternoon, everybody. Hi, I'm Paul Horrocks. I'm leading the Private Finance for Sustainable Development team here at the OECD. Very excited and happy to be leading the OECD Blended Finance Funds and Facilities presentation today. But I'm not actually running the survey or going to present all the juicy facts and insights. It's going to be my colleagues here to briefly introduce themselves, if they may. Irene?
Thank you, Paul. Welcome, everyone. This is Irene Basile. I have been working on the Funds and Facilities survey with the help of my colleagues. We have some technical issues.
If you can do a sound check.
Can you hear me? If you can hear me, can you please text the panelists? There seems to be an issue with the microphones. We're good? Okay, then I'll continue. As I was saying, I've been involved in the Funds and Facilities survey over the last 2 years with the help of many colleagues, and I have been in charge of drafting the deliverable, which is a working paper of the OECD Development Cooperation Directorate, where more details are presented, and we'll here give you some highlights. Thank you. And the work has been supported by Jared. Jared, you want to introduce yourself?
Hi everyone, this is Jared Dutra. Thank you for joining us. As Elena mentioned, I also have been helping out and supporting this project, and we look forward to going through the presentation with you and for your feedback and questions. Thank you.
Thanks, Irene. Thanks, Jared. So basically, we've got an hour, but we might run over that. There's a fair amount to get through. I'm going to give a brief introduction, then pass over to Irene, and then we'll have Jarrett, and then we'll follow up with some questions, and then I'll close. I mean, this is really an opportunity for you to provide your thoughts, your experiences, and so we also want your reflections on the survey. This is what we want to get out of this, and brainstorm on how they could be interpreted, but any advice, views on the survey when we take it forward in the next iteration would also be useful. And you will be invited to do that in terms of the design and both in terms of the organizational and the investment strategy that we can get better results from the next survey. Just in terms of just a bit more on housekeeping, when you do have questions or comments or suggestions, please direct those questions to the question moderator. Okay, so if we can go to the next slide. Thank you. So I'm going to give, as I said, a bit of a brief introduction, and then we will go into the real substance, which Irene and Jarrett will present. Just to say that we think this is really important work. We think it's really critical that we shed more light on funds and facilities. This is very much a growing area that's under the radar of policymakers and development actors. So it's critical that we bring this to light in a transparent and evidence-based manner. So let me just provide a bit more context. As we all know, ODA is in a sort of slightly downward trajectory, and both fell in terms of overall in 2018, but also to LDCs. Despite this, we've got this humongous agenda to shift money towards the SDGs, and the funds and facilities are a critical part of that. So we really think that helping to identify good practices, good approaches that will allow us to both have the impact and scale up through this work is critical. So that the survey has really got three sort of goals, if you want. Get a better overview, what's happening in the market, who's doing what, how are they doing it, where are they focusing. We also wanted to understand the risks. This is very much a sort of, a lot of these have got sort of development goals, but they're engaging with the private sector in a commercial framework. So that it's critical that we bring this to light and understand how they're attracting that private capital and what sort of risk they're undertaking to bring that capital in. We also wanted to explore in particular what their development impact would be and how it could be tracked and evaluated. That is going to be a subsequent report to this, which Irene is currently working on, and we hope to bring that to light. So let me sort of just give a sort of highlight that's a new piece of evidence that we think is also critically important. But at the moment, we are finalizing that, and we'll come back to you with the results around that. So in terms of the responses, well, this year we've been much more substantive. We have 180 responses, which is a marked increase on the last time we did the survey back in 2017. We now have 60 billion assets under management and 94 facilities and 86 funds. That's against 74 in the last year. So in terms of the methodology, who took part? Well, we had 700 funds and facilities that were invited to participate. We basically built on the excellent work that was done by the European Development Finance Institutions, or EDFI, back in 2015, and taking this survey forward. So we've got big ambitions to further roll this out. And then as we see all these funds and facilities growing in number and size, I think the survey, of course, will become increasingly important to policymakers and development actors. The assets, so we've got 60 million that are sitting there now. These aren't flows, these are assets that are invested. So it's a different collection approach than what we normally do at the OECD. So these are assets under management. What did we have back in 2017? Well, we had only about 30 billion, so we've doubled it. We know we're not completely representative of the whole market, but I think we're very close. So statistically significant numbers now, and I think based on capturing all the big funds and facilities, we can be quite confident that we really are showing what's happening in the marketplace. However, I do want to, the OECD is very much an evidence-based organization. I do want to clarify that we don't believe it's completely exhaustive. There are lots of funds and facilities out there, smaller ones, actors, also in developing countries that are playing an important role to development that might not have been captured. So we want to increase the coverage and get more comprehensive data on the trends and overall finance market. So that's the goal. And we want you to also contribute and help us achieve that through your feedback and suggestions. So now I'm going to just give a bit of a teaser of what Irene is going to talk about. And she's going to talk a bit about the structure. So in terms of investment strategy, who are the market players? What investment strategy do they have? And how is their portfolio allocated? And then she'll maybe talk a bit about the development performance, which is forthcoming, but probably just touch on that briefly. That's, I think, enough from me. Now I will pass over to the real substance, and over to you, Irene. Thank you.
Thank you, Paul. I wanted to say that, first of all, one of the main outcomes of this work has been to try and conceptually clarify what we mean by blended finance funds and facilities. And this has been done through a number of documents that have been iteratively discussed together with the Development Assistance Committee and representatives of this world, such as the DFI Working Group. So just going back a couple of slides, as you can see here, we have attempted to, first of all, come up with a definition of what are these collective investment vehicles, where resources are pooled to mobilize additional finance for the sustainable development in developing countries. And the OECD definition right now implies that these investment vehicles have a defined separate legal status, that they pool funding from different sources, that they do invest in developing countries, and they have this either explicit or implicit objective of mobilizing additional finance but also that they have their own accounting and financial reporting structure, so that they are not completely immersed into the organization that manages them. Furthermore, so within this umbrella term of collective investment vehicles, the OECD has attempted to further decrypt how they function. And this brings us to the definition of blended finance funds and facilities. So as you see here, the total population of collective investment vehicles that we have identified has been further analyzed and split into two broad categories: blended finance facilities, or also known as facilities for blending. Why? Because they pool within their capital resources that already have a development mandate. So they're already deployed for development purposes, but they aim to blend farther downstream at the project level. So typically these facilities will have in their capital development finance providers that can be either public or private, that can deploy their capital at concessional or non-concessional term, but that already have a defined development objective. And secondly, there's the category of blended funds, which are already blended in their capital structure. So within those assets under management that are sitting in the fund, there's already some commercial resources that do not have or did not have a development mandate before, and that are now being blended with development resources in order to work for the sustainable development of the developing countries. Within blended funds, we've identified two additional subsets of typologies: the flat ones, or the one tranche, meaning that all investors come in with the same terms, they take on the same risks, and their financial return is paid out at the same conditions. Whereas in structure fund, typically there is a different allocation of risks and return, meaning that some C shares owners will be paid out later after those more junior share owners. So they implicitly take more risk, and thereby they might hope to mobilize more concessional resources. And typically in funds, they might aim to mobilize or blend at two levels: at the capital level, as I was just saying, but also at the operational level when they do each investment and each operation like facilities do. And of course, in this survey, we are only capturing, as Paul mentions, those 60 billion of assets under management, which are really sitting at the capital structure. So we have not yet gone as far as to quantify the blending that they might undertake at the operational level. One further note is that this categorization and this sort of glossary that has been proposed by the OECD is to some extent irrespective of how these vehicles might be named or branded, because as we were saying, in the market, there's some confusion, or at least the terminologies are not yet very well settled. So we have tried to apply these categories irrespectively of how they are marketed as a fund or as facility, but really looking at how they function and what type of investors have come into their capital. One of the initial results of this work within the OECD has been to pull together this data set of over 700 vehicles. And as you can see here, we have mapped them out by their launch date. And obviously there has been an explosion, especially over the last decade, at least from 2000, particularly from 2012 onwards. But if we count the last decade between 2008 and 2017, we could identify almost 200 new vehicles that were launched. And in particular, this is even more significant if we consider that over a third of them are actually evergreen, meaning that they have no fixed term dates. So they might be operating on the market with a revolving structure. And the large majority of them, beyond those 39%, will have a lifespan of 5 to 15 years. Another thing that we were able to map is that most of these funds are headquartered in OECD countries, but quite a significant number is also based in Africa. Of course, half of them are actually in the Mauritius. But there are some, at least a dozen of the funds that have answered the OECD survey, so a dozen over 180, that are both based in a developing country and operate in developing countries, the same but also regionally beyond the national borders. Because as Paul mentioned, our aim was really to track international development cooperation instruments, so the survey did not yet capture purely domestic blending vehicles. Now going, sorry, skipping. Okay. Fix it. Okay, I have it. Sorry. Going more into detail of the survey results, one of the first things that we did was mapping who are actually the players in this market of blended finance funds and facilities. And here you see the two pie charts represent the facilities for blending and the blended funds. So clearly, out of the total 60 billion, over 60 billion asset under management, over 40 of those 60 billions were actually represented by facilities, which then have a much heavier weight. And actually, the average size of facilities is almost double that of funds. So on average, amongst the 180 answers that we received, funds will have 250 million USD assets under management, whereas facilities have over 480. And this explains also their absolute weight that is much higher in the survey in terms of assets under management. What you also see here is, of course, that the players or the asset managers are very different, whether we're talking about a facility for blending or a blended fund. So facilities are, in terms of asset under management, very much under the responsibility of multilateral development finance institutions. And here, by multilateral development finance institutions, we mean the likes of the multilateral development banks, such as the World Bank and in particular the IFC, the International Finance Corporation, but also the Asian, the African, the Latin, Inter-American Development Bank. And last but not least, EBRD, of course, the European Bank for Reconstruction and Development. An important share of facilities is also directly managed by bilateral development finance institutions. So development finance institutions set up by governments, most of them OECD members. By contrast, funds, as you can see in orange, are most assets sitting in funds are most largely managed by commercial asset manager. And this explains or can hint to the actual difference also in the deployment and the strategy that these two types of vehicles may follow. So for instance, we see that almost 60% of facilities are managed by multilateral DFIs in number, and almost 80% of funds are managed by commercial asset managers. Looking at the investors, so who actually contributed the capital sitting in these vehicles, again, the difference is quite apparent and stark. Governments are the main investor in absolute terms, first of all, both in funds and facilities. They contributed about almost 65% of those 60 billions that we surveyed in total. And as you can see in the facilities, they represent a huge chunk, so over 33 billions were directly contributed by governments, and this includes also bilateral development agencies for the purpose of this survey. Whereas, as you might have noticed, in contrast with the previous chart, they only managed a very small number of vehicles, 17 out of the 180 surveyed. So they are a big capital contributor, but they're not at the steering wheel, not necessarily, or only by delegation. Looking at funds, what comes out more impressively is the variety. Funds in general manage to mobilize a more diverse set of investors than facilities. This is also, of course, due to the intrinsic nature of the OECD definition, whereby already mobilize both development and commercial assets within their capital structure. And in particular, when we look at the investors, you see that there's a big variety where we have bilateral DFI, governments, but also private foundations and multilateral DFIs coming together. And finally, commercial asset managers and other investors such as pension funds or insurance companies. This chart, the pie chart on the right in particular, clearly exemplifies the high intermediation and the complexity in steering this type of instruments for the purpose of development cooperation for our member governments. Here we look at the sources of capital, and we asked our survey respondents to report their assets under management according to the mandate and the terms of the at which the capital was provided. So as you can see, we describe this as either development finance, meaning that it has a development mandate almost by legal definition, whether it is concessional or non-concessional, and then purely commercial finance that does not have a development objective. So by definition, facilities are purely pooling development finance, and therein we see that a large majority of it is actually concessional. But even overall, across the two type of instruments, 78% was actually concessional. So there's still a very high degree of concessionality within these tools that are used for blending. And this brings us to say that they are indeed worth looking at when we're talking about innovative development finance mechanisms, because there is indeed a large amount of official development assistance that is potentially challenged through these vehicles. What we see, and looking still at the facilities, we have some development finance that is non-concessional, and this is typically deployed by the development finance institutions, whether they're multilateral or bilateral, and also by philanthropies, for instance. Looking at funds, you see that there is almost a quarter that is 4.4 billion that represents commercial finance. At least that's what we could survey at the capital level, sitting in blended finance funds in 2017. The main commercial capital providers are pension funds, but also high net worth individuals, insurance companies, commercial banks, and commercial asset managers. We also could see, though it's not pictured here, that indeed structure funds mobilized a little more commercial finance than did flat or one tranche funds. So out of those 4.4, almost 2.4 was mobilized by structure funds. And again, these are very significant. This is very significant new data, because if you compare it to the existing OECD statistics, so official OECD statistics on private finance mobilized, the amounts reported are quite different so far. So the shares in collective investment vehicles, according to official OECD statistics, mobilize only 8% of the total amount mobilized. So they are still a relatively small part of what is reported, but to the OECD by official donors. But to some extent, this survey managed to capture something more, something broader. And if you want, over the 6 years where official data has been collected by the OECD on private finance mobilized through collective investment vehicles, we identified $12 billion US. This is in the 6 years from 2012 to 2017, again, as it was reported to the OECD, which 12 divided by 6 would be a little over, just about 2 billion per year. And here we can see that with this survey, we already capture 4.4 commercial finance sitting in those funds. Now, of course, we're talking about flow versus stock measures, so they're not exactly comparable, but it is new important evidence that helps us understand how these vehicles are managed, who invests in them, and indeed the fact that there is little evidence right now and that there is much more room for further research and data analysis. All right.
Thank you, Elena. So I will now go into the investment strategy. For this section, the first 3 slides will deal specifically with blended finance funds. There was, in the survey, there were distinctive questions. Some were asked towards facilities and others asked towards funds. So we'll start off with who were the funds that answered. And so we asked funds to self-categorize themselves. We gave them 3 categories: fixed income, private equity, venture capital, and then we also gave them the option to enter in something else. And as you can see, we had about an even split between private equity and fixed income. So there were, in total, there was 33% private equity and then 31% fixed income, and with the remainder being 7%, so less venture capital funds, and then the remainder were in the other category. And to give you an idea, in that other category, we had answers such as currency hedge fund, we had challenge fund, and then we also had an umbrella fund, which had 2 sub-funds of both an equity and then debt sub-funds. And if you look at the left pie chart with the structured funds, you see we found more fixed income funds in the structured, self-categorized as fixed income. And then on the right, we see that private equity was more likely to be categorized as a flat fund. And moving past this, so just to give you an idea in terms of dollar amounts, it was roughly the same in structured funds versus flat. Structured had slightly more, so we had 10 billion in structured funds and then 8 billion in flat funds. And then we continue looking at these 3 categories specifically, fixed income, private equity, and venture capital. And we looked at how each were capitalized. And so what you see here are the percentages on average according to each category. So if we take a look at fixed income, we see that on average, with 17% of concessional capital. And then once we move on to private equity, we see that private equity actually mobilized the most commercial capital. So on average, we see that over half of the financing coming into a private equity fund was financed from commercial sources. And of course, these did vary quite a bit, but once we took the average, we started to get a better idea of how these different asset classes were being capitalized. And then the venture capital, as you see to the right, had the most concessional capital, which is in line with their risk profile. And moving on, we start to look at their return. And what we see is on the left, with private equity and venture capital, we see that their returns were a lot more diverse. And as you see, there was a large chunk of them, 10 in total, that reported an expectation of 0 to 5% return. And then in fixed income, it was more on the higher side in terms of return. So we asked them what percent over LIBOR that they would expect as a return. And we see that the majority, once you look at the 2 to 3% over LIBOR, it was about 20, making up well over 3/4. And we had very little, so we only had the 2 that actually noted that they would be their return would be less than LIBOR. And now we're going to move on to looking at facilities and funds. And so here in blended finance, we often mention the idea of the need to develop local capital markets. And one important factor in this is the use of local currency, which contributes to a more robust and resilient local market. So what we did was we asked respondents what percentage of their portfolio was represented by local currencies in their investment portfolio. And we gave them 5 different categories to answer. So you see on the top, no local currency, then less than 25, etc., up to 76% and higher. And the main takeaways from this, looking at it at a broad angle, we found that almost a quarter of all the total assets under management, so roughly 15 billion, were denominated in local currency. And most of this was in blended funds. As you can see, blended funds were a lot more diverse in terms of including local currency in their investment portfolio, with 3/4, let's say, looking at facilities in contrast, 3/4 of facilities having no local currency exposure. So this is that 69 number that you see on the left, out of the total 94 facilities that were surveyed. And then going a little bit further, we did ask a question regarding hedging. So we asked, if you do have exposure to local currency, to what degree are you hedged? We asked this only towards the blended finance funds. And what we found was 74% of structured funds that were invested in local currency were hedged. And the structured funds did tend to be more hedged than the flat. And flat funds were at 45% in comparison. And finally, we looked at the Sustainable Development Goals. So what we did here was we asked respondents if their investment strategy contributes to any of the 17 SDGs. And then we asked them to list all the relevant SDGs. And so, as you see here, it'll be the percentage of the respondents that answered for each SDG. What we found was, in general, 7 SDGs were targeted on average by our respondents. And this did slightly vary on facility versus fund. We found that facilities targeted 8 on average, and funds tended to be around 6 to 7, but in total around 7 SDGs. And as you see, the general shape going from 2016 to 2017 is quite similar. So this highlights mostly that the same SDGs are being targeted in the same manner. However, total respondents have increased. So for example, if we look at 40% of respondents listed SDG 1, no poverty, on the top in 2016. That then grew to about 70% in 2017 in this survey data. And some other notable jumps that you can see on the graph are SDG 5, off to the right, gender equality, with 55% of respondents. And then SDG 13, climate action, with 62% of respondents noting that they contributed to this in their investment portfolio. Other significant increases, such as SDG 3 and 4, were quite notable. So this is the good health and quality education. However, they still remain lower than some of the other SDGs being targeted, such as decent work, economic growth, and affordable and clean energy, in addition to no poverty. And just as a closing, there's no definite conclusion to draw from these. we're just trying to get an idea of both awareness and how the SDGs are factoring into these investment theses and the investment strategy of these facilities and these funds. And I'll pass it back to Elena.
Thank you, Jarrett. So the survey also aimed at understanding a bit of where the investment capital held by these vehicles, where it is going. Although, as mentioned before, we did not quantify the volumes in terms of dollars deployed. So what you see, for instance, here, we based the survey question on the leveraging mechanisms that have been identified by the OECD Development Assistance Committee in their negotiations on official OECD statistics. So those are the categories that you see. And each vehicle could answer more than one option. So they do not sum up to 180 because, of course, each vehicle could potentially deploy more than one type of investment instrument or leveraging mechanism. What comes out of this bar chart is that direct investment in company is indeed the most popular type of investment instrument. 65% of the 180 respondents did say that they use direct investment in companies, and this can be both equity and debt. So unfortunately, we could not capture that level of information, but hopefully that's something that we can dig into for the next survey edition. This confirms that collective investment vehicles are an important and potentially important tool to address, for instance, SME growth in LDCs or developing countries in general that we know have that high job creation potential in the future. Another instrument, more in generally looking at the difference between facilities and blended funds, so facilities in yellow, blended funds in green and blue, you can see that facilities tend to be more using the left side of the spectrum, so grants or guarantees. That's the instruments that were more frequently selected by facilities, whereas funds are more concentrated on direct investment, but also on syndicated loans in particular, and to a lesser extent also on credit lines. In particular, in grants, 64% of the 94 facilities surveyed did do grants, so it is one of their main tools. However, what is interesting to bear in mind is that ultimately the terms of the capitalization of these vehicles do not necessarily reflect on the type of instruments that they deploy. Why am I saying this? Because indeed 1/4 of those facilities that were purely financed by concessional capital, well, they did not report using grants. So again, here we have a case where the concessional development finance might actually, on the way in, might actually be turned into development finance or investment type of mechanisms on the way out. We also looked at who are their preferred investees. Again, this was an open-ended multiple choice sort of question. And of course, since they very frequently do direct investment in companies, as you can see here, companies are their most preferred type of client, reported by over 60% of facilities and over 70% of the surveyed vehicles, funds, sorry, 70% of the funds. What type of companies? They were asked to describe their typical investee, and they were more likely to invest in local companies as opposed to international ones. They were more likely to invest in SMEs as opposed to bigger multinational companies. And they were also more likely to invest in growth stage as opposed to early startup phase. And this is coherent with the fact that we had indeed very few venture capital instruments in the surveyed population. 1 in 2 of the vehicles also targets financial institutions, which can of course be an intermediary to reach farther downstream companies or we also learned that they, in general, when investing in physical investment or purchases, they prefer greenfield to brownfield projects. And in general, taking a bird's eye view, what we can see here is that facilities can cater to a wider array of clients, and this can both be attributed to their higher level of concessionality, but also their bigger size in general. And this includes, of course, sovereign administration, which here is really public administration because it includes both national and local public authorities. Looking at the geography of where their operations are directed, this information we could capture for about 40 billion of those assets under management, so not the totality, because the respondents were asked to name their top 9 countries of investment. So it's not exhaustive indeed, but what we see is that 28, almost 30% of the assets under management went to Africa. So 70 billion out of those 40 billion that were reported to us. And indeed, most of it was through facilities, so potentially concessional. We also learned that it's not represented here, but out of those 40 billion, about 7.6 went to least developed countries. And therein, there were some funds also investing in least developed countries. And so we see that out of the 4.5 billion of commercial assets that were sitting in blended funds, about 7.5 was deployed in LDCs. And this, again, is coherent, corroborates the official OECD statistics, whereby around 7% of the private finance mobilized by development finance intervention is going to LDCs. You can find more information if you're interested on the LDC topic in our publication series that we've collaborated with UNCDF, the UN Capital Development Funds, and we produced 2 reports on blended finance in the least developed countries. They were also asked where they invest in terms of sectors. And again, this graph corroborates well-known information, that is that blended finance is more focused on revenue-generating sectors, in particular energy and banking and financial services. These two together represent 13.5 billion, which is over half of the amount we could capture both by sector and region.
Okay, thank you very much, Irene. Thanks, Jarrett. This is now over to you for your questions, thoughts. As I said at the beginning, please direct them to the question moderator, and we will try to answer them. I don't know if we'll be able to answer all of them, but we will have a crack, and if not, we will come back to you when we can look at them. So maybe we can start off, and we will try and read them out, and yeah.
Hello, thank you. So we'll start off with a question regarding the database that we mentioned, the population, the over 700 collective investment vehicles, and whether or not it was publicly available. And as of now, it is not. This is still a ongoing, growing, evolving population. So for now, it's not available.
So what is available is, again, the definition that we outlined in the beginning of the presentation and the list of respondents. So the 180 respondents to the survey this year, you will find those in annex of the working paper, and the working paper will be disseminated to all of you registered for this webinar. Thank you.
Thank you. Our next question was regarding the investors. So it was regarding the other category for funds. There was a question regarding whether or not there was any high net worth individuals or family offices included in that. And the answer is yes. Included and that 3.4 billion were approximately 400 million in high net worth individuals, and then also family offices. And then also included in the other category are corporations, private institutional investors as well. And the next question we got was regarding the concessional capital and fixed income. And this was something that we also had a question on. The question is, why is there more concessional capital in fixed income when it is less risky? And I think this is something, hopefully, as we go through these iterations year after year, we can start to see whether or not this is a trend or whether or not this is just something that happened in the data today and this year in 2017.
Paul, do you want to? So one of the reasons might also be that, of course, we are, first of all, talking to official development finance providers. Through this survey, we have tried to reach out also to commercial asset managers and private impact investors, but the main interlocutor of the OECD remain official development finance providers. And as some of you know, concessional loans have long been integrated into our tracking of official development assistance. So there might be inbuilt into the way that the methodology was deployed and the survey was administered, there might be a bias towards debt reporting and loan instruments. But indeed, we were also surprised at the high rates of concessionality, and it's something that is worth exploring further.
Yeah, maybe just to add, I mean, we were surprised by that. I mean, intuitively, you would think that there'll be more in equity. We have seen a shift by DFIs and other financial actors moving into more venture capital and more risky type operations and using concessional money to do that. There is an interplay here between using debt to mobilize and equity. So, you might have more sort of first loss on your debt and other instruments to be able to mobilize more significant amounts of private sector capital. But yeah, I think that we will follow up on this. I think it's something that surprised us a bit. I think that's part of the answer, but we will try and keep an eye on that particular trend. Thanks.
Great. So our next question was if we know the share of debt providers that provide local currency. And so when we look at fixed income funds, most of them did provide some form of local currency. It was roughly 80% of all fixed income funds. And another question, follow-up, was also whether or not hedging was more used in these debt funds, these fixed income funds. And looking at fixed income versus private equity, we did find that hedging was more prevalent as well. Looking at, sorry? So going on, go ahead.
Let me just interject there, if I may. I mean, just to say, of course, you want to hedge more on sort of fixed income where you're getting coupon payments. There might be, it's a longer term operation compared to equity where you sort of come in and then you exit, and you don't want to have expensive hedging. So there is a sort of thinking about the instrument that whereby you will be getting potentially dividends and other payment streams that are going towards those fixed income over quite a significant amount of time, where you would want to take that hedging risk, or take the FX risk through a hedging instrument off the table. That also goes for private equity as well. And I think, Africa's mainly a private equity play. Depending on the actor, it'll be in USD or in the local currency. So and of course, if you move up in terms of fixed income, you're talking about bigger volumes, and therefore, and also often foreign funds and money, where you need to have some hedging instrument.
Thank you, Paul. The next question is, are more innovative financing systems such as impact bonds, outcome-based funds, also included in the study? And how are they categorized?
Paul, I think this touches over the question that we've been dealing with for a few years now of how blended finance and impact investment differentiate or overlap. Do you want to give it a quick try?
Yeah, I mean, this is a whole kind of area which we're sort of taking forward, and I think we've seen impact investing becoming an increasingly growing area, and it's tending to go a bit more into mainstream now. Of course, there's much more desire and push by DFIs and the owners of the DFIs and those the ministries of finance, but also ministries of foreign affairs and donor agencies that want to understand the impact. So this whole impact narrative is moving into a sort of phase where we need to have much more evidence around the impact and understanding, but also in terms of the monitoring and evaluation, which will be dealt with through the future report that Irene is going to be coming out with in October. Yeah, that's I think it for me on that.
So more in the nitty-gritty, many impact investors were indeed included in the survey. We fully exploited, for instance, the GIN survey on impact investor that is done every year by the Global Impact Investing Network. So many of the likes of Blue Orchard, Responsibility, Triple Jump, they have been closely associated and have indeed answered this survey. So yes, many impact funds would be captured here. And as I was saying, what the OECD is trying to do is really to build a common language despite how these instruments might be branded. Now, if the question relates to social impact bonds or development impact bonds, these are very often one-off operations that would not be captured because we really aim to look at financing structures that have a legal entity of their own and have, as it was saying, a separate reporting and management system. So impact funds, yes. Specific outcome-based contracts, no, those are outside of the scope of the study. But first and foremost, in order to be blending and to be classified as blended finance funds or facilities, they should have this purpose of mobilizing additional commercial finance, which is not necessarily an objective on all the impact investors, right? So there is some additional coloring to this definition.
Our next question was how to be included in the NETS survey, and so we're looking to launch this early next year, and we will definitely include you on in the mailing list, and just look out for it early next year. And the next question is considering the investment from governments into facilities, most of it managed by multilateral institutions, whether or not this is accounted for in ODA. And the answer is yes. And then I think you had a follow-up question as well.
So what is accounted as ODA would be the contributions that go from bilateral governments into multilateral development banks and those concessional finance instruments that go from multilateral development banks out to developing countries. The funds and facilities, again, are not the amounts captured in this survey on funds and facilities are not flow measures, but they're stock measures. Right, so there's also another layer. The two data sets cannot be added up.
Thank you. And for your follow-up question, I know it was regarding the growth in these assets under management. And since this is the second iteration, we are still developing trends. And so hopefully after one or two iterations, we'll be able to more clearly provide that kind of data.
Just to add to that, I mean, we know that these funds and facilities are profitable. I mean, a bit like DFIs. So they are growing. They can do more, and I think that's also the objective. What we do see though is you want to build scale and bring in more private sector. You've got to kind of maybe collapse and bring together some of these funds. Ultimately, it's still, I think, disappointing the private sector participation in the funds. And we want to ensure that there's more of that, and hopefully by having some larger funds or some better coordination, then we can have more impact in the regions and SDGs that we would like to.
Our next question is, why is it that funds invest more in local currencies and facilities? And what could be some factors influencing such a choice?
I will have a shot at that. I mean, funds, of course, are more commercially focused and so probably take less risk, whereas facilities have more of a concessional element and therefore can have take more of the risk in terms of the foreign exchange. So, I mean, it's a bit about matchmaking your liabilities with your revenue streams. So if you're a fund, you want to do that. And I mean, from our perspective, we want to push more local currency financing because that typically links with the revenue stream and takes away these the hedging risk, which is a big issue for investing in these regions.
Yeah, just to add to what Paul was saying, the fact that funds also have a more diverse set of investors might mean that they also have to take more precautions and that they have more requests for actually reassurance on their capital. And finally, one thing also to be considered is that many facilities tend to themselves provide concessional financing to funds. So although we have not yet produced evidence on this, many facilities tend to be further upstream at a bigger level, purely concessional, very often deployed side by side with funds, where the facility takes care of the technical assistance capacity building element. So in that sense, much of the hedging that is taken place at the more operational level within closer to the investment and that is done in fund might go side by side with what is deployed by the facilities, because very often, as I was saying, facilities are actually deployed side by side with other funds if we look, for instance, at how the MDBs or the DFIs are functioning.
Thank you. We had one question regarding the graph on the SDGs, and I think it's a very good point in terms of what we're saying, or what we're not concluding here is that there is not necessarily alignment with 70% of respondents, for example, with SDG 1. And I think we've heard this feedback from many respondents, and this will feed into our next survey. And we definitely welcome further feedback in how we can phrase this question regarding the SDGs.
But yes, indeed, the question was formulated based on their formal investment strategy and to what extent they explicitly pursued an SDG. We did not investigate further as to how their portfolio was allocated based on that SDG. However, the second part of the questionnaire that relates to the development performance did look into what monitoring indicators these vehicles have adopted, and if they have translated into quantified targets, and how they are fed, how often, by whom, on what sources. So on these questions, indeed, we are aware there might be some impact washing, so-called, and the fact that a vehicle aspires to contribute to an SDG does not actually mean immediate results, but that is true for all financing. We will dig into a bit more deeply on this subject in the forthcoming paper, so I invite you to stay on the lookout for that.
Thank you. We do have one other question, which I believe was partially just answered. It's regarding development impact created by blended finance structures and what we know concerning them.
Yes, the survey that far. What we did look at, however, were their broader accountability approaches, let's say. So we did ask if they, for instance, have been evaluated independently or not, if they do impact or results reporting annually or not. And this will be explored in the next working paper. Again, here, the purpose of this survey is just to sort of demystify and unpack how these vehicles work, not so much as to try to assess, not yet, whether they're effective or not in terms of development impact. I think it would be too much to ask out of this very survey that is only at its second year of life. But on the other hand, as you might know, the OECD has done additional work on blended finance evaluation, and the Development Assistance Committee has set up this year a specific working group looking at blended finance evaluation. And we indeed aim to propose both further guidance on how to evaluate blended finance at large, but including specifically on these instruments, and also to look at the effectiveness or the evidence available on the development results of specific investment instruments, whether they are funds and facilities or more in general equity investment, for instance, or guarantees. I think we have already gone over time. Jared, do we have one last question or?
We do have one last one. So the final one, in continuation, I think, from the local currency topic, which is, would we expect to see more local currency investment in facilities managed by multilaterals? And I think in general, I think Paul and Elena did a good job at giving a quick overview and the idea that these facilities do a lot of on-lending, and further downstream, it's very possible that they do promote local capital markets by using local currency.
Yes, if I may, one additional factor to consider here is that so far the offer in terms of local currency hedging has been, well, the most developed with respect to all insurance instruments, but still relatively nascent. And the ticket sizes have been renowned to be quite big, for instance, with TCX, that is indeed one of the biggest players on the market, although there are more and more players proposing hedging solution also for smaller tickets. So because of the offer of hedging solutions available, it might also be that bigger players with bigger portfolios have more easily access to them. Yeah. Okay, Paul, just for the wrap up.
Yeah, so again, thank you very much.